So the next topic is interest rate options. So we have already discussed about options in the previous sessions, and interest. Just a second, I'm just sharing the screen also. Can you see the screen? Please confirm me. Hello. Can you see the screen?
It's
Please.
blank, sir.
Sorry.
I can see this. I can see the screen, sir. I can see the screen.
Okay. Okay. Yeah. So you can see the screen now. Okay.
Yes, sir.
Yeah, let's start. Yes. Yeah. So great. So we have discussed about the options in the previous sessions, and the previous sessions were completely focusing on stock options. But now we are going to discuss about interest rate options. So it is very simple to understand. See, suppose there is Mr. A, and he wants to take a loan from ABC Bank. So what Mr. A does is he has one option. He can go to the bank. Okay, see, options are traded. So I am just explaining you the conceptual thing behind this. Okay. So what Mr. A can do is, see, this can also be understood like a forward agreement, but it is not forward agreement. I'm speaking about options. What Mr. A can do is he can take options. He can take options by fixing a rate. Okay, so there are two types of options when it comes to interest rate. One is price based options and one is rate based options. So what is happening in this interest rate options is, let's see what's happening very simply, they have explained this. So interest rate options can be used. So I'm not taking this example of Mr. and ABC Bank. You will be getting confused with forward agreement and forward rate agreement and interest rate options. So let's go with the textbook version simply explained here. So interest rate options can be used either to speculate on the direction of future interest rates or to hedge a portfolio against future interest rate changes. Of course, so you can take interest rate options to speculate. That means banks, what they do is, in future the rates are going to be high, let's say. So what one bank can do is they can take they can speculate if the rates are going to go high, okay, in the future. They can take loans at a rate fixed. Suppose there is a bank which wants to borrow some $1 billion from bank A. It is bank B, they want to borrow $1 billion. So if bank A wants to borrow $1 billion from bank B, not a small amount, and today the prevailing rate is 2%, and it seems that in the future, after 3 months, when he wants to borrow, the interest rates can go 4%. So what bank A can do is they can make an agreement. Okay, that means they are taking options. They are taking options to take a loan, or they are taking an option. See, I'm clearly saying we already have discussed about stock options. Thereby, the investors, they take options, and they buy stock at a price fixed beforehand, and that price is called as the strike price, and they'll buy the stock at that rate, at that price from the option writer. Am I right? So here is A, here is B. He is a writer, he is an option buyer. So he has option, he has made a contract with A, as per which he will buy SBI stock for 100 rupees after 3 months. Okay, $100 after 3 months from A, and A has to sell that stock to B at that price only. That was the thing what we discussed. So bank A is making a contract with bank B, an option contract, let's say, as per which bank A will borrow from bank B at the rate of 2.5% after 3 months. Okay, because they think that the rates are going to go up, so they'll borrow at 2.5%, and suppose, let's say, the rate has gone to 4%. So for them the loan has come at 2.5, and they can kind of, what they can do, they can again again lend it at what rate? 4% in the market, correct? So they are making, what is the differential here? 1.5%. 1.5%. That is what bank A can earn. Am I right? Please tell me yes or no. Hello. Did you understand the concept? Hello.
Yes.
Yes, sir.
Yeah.
Hello.
So bank.
Yes, sir.
Yeah. So did you understand? No? So bank A has made an option, has a contract with bank B. Let's say bank B is option writer. Which option writer? In rate based option writer. Rate based means interest rate based option writer. So bank A is taking an option from bank B, as per which bank A will borrow after 3 months from bank B at the rate of 2.5%, because they are speculating that the rates would go up and they want to take advantage. Why? Because they can borrow at less rate and they can charge a higher rate to the other people to whom they can lend it. Isn't it so? That is what they want to do. So this was about the, excuse me, just a second. So this is what it is done, and like they can also hedge now. So what is that? Like bank A, this was speculation. Bank A thinks that the rates in the future are going to decline. Let's say the rates are going to decline. So what they can do is they can make a agreement or contract with bank B, as per which they say that I will be giving you loan in the future at the rate of 4% interest. Now you'll be thinking, why bank B will accept? See, both have different perception. In market, when two participants meet, they have different perceptions. Bank A thinks that the rates are going to go down, but bank B is worried that the rates are going to go up. And anything can happen. If bank A thinks rates are going to go down, it's not necessary that it will definitely go down. That can also prove to be wrong. Okay. And bank B thinks that the rates are going to go up, but it can also go down. That can also be wrong, like perception. We cannot say about the markets, but this is what their perception is. And here, like we discussed now, 2.5% bank A is going to take the loan and they're going to like lend it for 4%. Let's say if the rates, this is the strike, let's say this is like SBI stock now, $100. If the stock goes up, they will definitely exercise. In this also, the rates are going up, they are getting at less rate and they can definitely lend at higher rates. But if let's say the interest goes down, it goes to 1%. Do you think that the bank A is going to borrow 2.5 and they are going to lend at 1%? No. In option, what they can do is they will let this option lapse. In forward agreement, they have to take it. Why? Because that is an obligation for bank A. You understood? For 2.5%, the rate is fixed. If the rate goes to 4%, they can borrow at 2.5 and lend at 4. But if it goes to 1%, they'll let the option lapse. Why? Because it is unacceptable for any one who is in option contract to exercise the option if they're in losses. Okay. This was rate based. Now price based is simple. Price based interest rate option is nothing but an option on an underlying financial instrument such as specific treasury note or treasury bond. This is a money market instrument. This is a discount instrument actually, because treasury bonds are, sorry, not treasury note, treasury bonds. Treasury bonds are always usually issued at discount and redeemed at par. Okay? That gives the buyer of the option. So what is happening? Price based interest rate option. We have right now discussed about the rate based option. We are now discussing about the price based option. So price based interest rate option is an option on an underlying financial instrument, some bonds, such a specific, some, let's say, treasury bond, that gives the buyer of the option. So Mr. A is the buyer of this option, the price based option. So he is buying an option, okay, in exchange for payment of a premium. So to take an option, he has to make what? Nothing comes for free, correct? So he will make a premium payment for buying this option. Okay, in exchange for payment of premium, the right to buy or sell the specific bond at a specified price on or before the expiration date of the option. So what Mr. A is doing is, Mr. A is the option buyer. He is making some premium payment to option seller Mr. B, and what he is agreeing, what is the option, what kind of option this is he is making a contract with Mr. B to buy some security or some bond at the rate of $95. Okay, because he thinks that the bond price is going to go up. The bond price or the security price is going to go up. Let's say it's going to go 98. So what he wants to do is he wants to buy at 95 and sell at 98. Did you understand what I'm trying to explain you? Please tell me. Hello.
Yes, sir.
Yeah. So this was a call option. Now suppose, let's say Mr. A takes an option from Mr. B, as per which he fixes the price of the bond to 95, that he wants to sell at 95 only. If the bond price goes to 90, then still he will be selling at 95. He will be buying at 90 and selling at 95. So that is nothing but put option for this bond. So there are two options, call and put. Call is nothing but a option which gives right to Mr. A to buy a particular security at a specific or specified price which he has fixed it today itself. Okay. Excuse me, just a second. So here I was speaking like Mr. A has taken an option from Mr. B to buy a security at 90, and he can sell the security at 95 in the market and make some gains out of it. If the security prices goes, let's say Mr. A is buying the strike price which Mr. A has fixed to buy the security. Security means any bond, any company's bond, for 90, let's say. Okay, and in the market the price has gone to 95. He'll exercise the option because he'll get a $5 benefit or gain. If it goes to 80, he will never exercise. He will make the option to let it lapse. Point number 2 is in put option. If it goes down, he will exercise. If it goes up, he'll never exercise. Okay, the only loss is premium loss. Fine. And why this? What would happen? See, if $95, if I fix the price of the security that I want to buy at $95, if the security goes to 90, if the security prices goes to 100, this is only possible if the interest rates, if the market interest, see what happens, what is the relationship between bond price and market interest rate? When bond price increases, market interest rate definitely has decreased. Am I right or wrong? In long, like you have learned this in the previous like chapter, correct or wrong? When market interest rate goes down, the bond price goes up. Yes or no? Please tell me. Yes, yes, yes. But no need to relate all this. Just understand what I've explained you. That's enough. Don't relate all this. Leave it, leave it. I don't want to complicate. So price-based option when exercised result in delivery of underlying security. Price-based interest rate options on treasury notes and bonds are for par amounts of 1 lakh or on treasury notes or bonds. Price-based options on treasury bills are for par amounts of 1 lakh on specific treasury bills. So this is what they are saying, that price-based options when exercised result in the delivery of the underlying security. Suppose you want to buy, so the other party has to deliver the security to you, correct? Now price-based interest rate options on treasury notes, this is one of the securities, and bonds, that is another type of security, are for par amounts of 1 lakh on specific treasury notes or bonds. So what happens is, you will buy the security. So what happens is, see, every security whatever you buy, you will be buying at some price, but you will be redeemed what? The par amount, isn't it so? Hello, yes, yes, fine. Did you understand what I'm saying? Hello.
Understood.
Yeah, that's fine.
No.
Sure.
Yeah, so this is what we have finished the concept. Let's go for the swap agreements. So I will explain you the swap, what is a swap, and we'll go for a question for and we'll understand how does the swap agreement works, interest rate swaps. Okay, fine. Hello. Hello. Yes, sir. So let's understand about the swap. First, what is swap? Okay. See, swap means exchange. What kind of exchange? You have heard about marriage bureaus. Many people know about marriage bureaus. What does marriage bureau people do? There is bride and this is bridegroom family. Okay, male and female. What these guys do is, these guys are the intermediary or mediators between these people. What they do is they exchange the like photos and all to these people. They take from them, and from them they take and share to these people. And for that, what they are doing, they are charging some fees. Correct or wrong? What they are doing is they are swapping the profiles. What are they doing?
Swapping the profile.
And they are charging some fees for that, and that is done in real world. This is done. And now I'll replicate this concept like in terms of finance. In real world, there are swap banks. So these swap banks are the banks which make this swap agreements happen. Okay, they make this swap agreements happen. So what they do is like we will not make this concept very complicated. We'll make it very simple for you to understand. We here we are not going to learn about all this mechanism of how this swap and everything happens. We are just going to learn about the concept of swap. So let's say there is A and there is B. Okay, this guy has taken a loan from Kotak Bank, and this guy has taken a loan from HDFC Bank. Now Kotak Bank has offered a loan of 10 like say like 12 lakhs. Okay, and Kotak is charging let's say 7% from A. What Kotak is charging? 7% from A, and they are charging 7% fixed from A. That is fixed rate. Okay, so Mr. A wanted a loan from from various banks, so he approached Kotak Mahindra Bank. Kotak Mahindra Bank has assessed his ratings, credit ratings, his credit worthiness. They have done a background check and everything, and they finalized that Mr. A is eligible to get a loan of 12 lakhs at the rate of 7%, which would be fixed, not floating. Let me be very clear. Now don't ask me like why floating, why fixed. See, that is not the cup of tea. What we want to know is how the swap works. That's it. Okay. That is a bank's at bank's discretion. You will be getting a loan, and the bank will decide like on what basis they have to give you loans and how much they should charge. Okay. B has borrowed from HDFC Bank, and which is charging some floating rate interest to B, and a loan of 15 lakh has been sanctioned to B. Okay. Maturity is like 10 years here, and maturity is like 15 years. Let's see. And what happens is, here the floating rate is LIBOR. In India it is MIBOR, Mumbai Interbank Offered Rate. Okay, I'm using LIBOR because that will be used very often here. LIBOR plus 1.5%, let's say. So LIBOR is let's say 8%. Okay, so 8.5% is going on right now. But you know, this LIBOR is 8% right now. LIBOR may change. Accordingly, if LIBOR goes to 9%, it will become 9.5. It goes to 10%, it will become 10.5. So when LIBOR changes, the floating interest rate would change, because it has a nature of it has a nature to be, the nature of it is to float. That will not be fixed. If the LIBOR goes down, let's say 7%, then this will become 7 point like 8. No, it's LIBOR is 8 now. It will be 9.5. Sorry. If the LIBOR is 10, it will be 10.5. If the LIBOR is 7, it will be 8.5. So it can happen. It can go up, go down. Okay, that is what its nature is. But this is going to be fixed in whatever the case may be. Now, what is happening here? I always tell you, people have different perceptions. So whenever you go to like this is a very funny example. Whenever you go to a party and you dine with your friends, and when you see their plates, okay, let's not discuss this. Whenever your father has a car, let's say you have a car, your neighbor has a car, okay, and what happens is, whenever you see your neighbor's car, you are much more liking that car. Okay, what people have is what we like more, isn't it so? What people have is what we like more. Your friend wears a t-shirt or a trouser or something, you like that more than what you wear. So it is a general perception. We are not satisfied with what we have always. The same problem is with Mr. A and Mr. B. They are not satisfied with the loan payments what they are making to their respective banks. A is fed up with fixed rate, B is fed up with floating rate. Because A is fed up and A is worried. B is also fed up and B is worried. A is worried that for example, because he has taken a loan today, after 5 years, do you think the market in which he is going, that market, like the market in which he is, okay, the same Kotak Bank is going to exist? So do you think after 5 years Kotak Bank is going to give 7% to the loan at the rate of 7% to people, or they're going to increase? They're going to, that fixed rate also they are going to change now. Am I right? It is fixed for A, but that the payments are fixed. but the rates may differ. Is it right or wrong? Please tell me if you are understanding. See, when 20 years back, when our parents have like asked a loan to bank, they that time they would have charged 10%, 11%. But now it is 7% fixed. That time it was 11% fixed. Let's say. So the payments are fixed, but the rates may not be fixed. Now, the rates, the standard rate may differ based upon the scenario. So what A is worried is, he is paying 7% to the bank. What if the market in which he has taken the loan, there the rates go to 4%? That means his friend has, after 5 years, his friend has approached a bank, and that bank is Kotak Bank only, and Kotak Bank is offering his friend loan of some 10 lakhs, 12 lakhs, okay, at the rate of 4%. Now what A is thinking is, this loan, whatever he has taken, he has a burden of paying 7%, but his friend is paying 4%, correct? Yes or no? Please tell me. He is worried about paying more interest to the bank rather than paying 4%, which his friend is paying right now. He is paying 7%. So he is very much dissatisfied. He doesn't like this. Okay. So he wants floating rate. He wants to make the payments at floating rate. What B thinks is, he is already taken a loan at 8% LIBOR plus 1.5%. Okay, that is LIBOR plus 1.5% is the rate at which he has taken the loan. Now, if the rates go up in the market, let's say LIBOR goes to 12%, so he has to pay 13.5%. He is very much worried. So both have their worries. He thinks that the rates go down, he is paying more. He thinks that the rates go up, he is going to pay more. So what they do is, they meet one day, okay, like what happens in general scenario is, swap banks arrange for all this swap agreements, okay, like the marriage bureau guys, because the bride family doesn't know the bridegroom family, and the bridegroom family doesn't know about the bride family, but he is doing the matchmaking. So swap banks will arrange this kind of agreements, and they will search for, the parties will approach this kind of banks, and the banks would match the parties and make this agreement happen. But let's say, I'm keeping it very simple, let's say A and B are friends. They meet one fine day and they exchange their worries. What A says is, boss, I have taken a loan from the bank, and I'm paying 7% fixed interest. But one of my friends has taken the loan from the same bank after 5 years today, and they are charging 4% to him. See, the rates have gone down, and he is worried that the rates have gone. So what they agree is, let's make a swap agreement between each other by fixing a notional principal of 10 lakhs. Okay, because here the loan is 12 lakhs and 15 lakhs. Notional principal is, the principal is for the namesake. The payments are exchanged here. So what they agree is, A is going to make the B's payments to B's bank, that is HDFC, and B is going to make the payments of A to the Kotak Mahindra bank here. Okay. So what they're doing, A, who is already, so I'll make a neat diagram. A, B, Kotak, taken a loan, HDFC, taken a loan. What they are doing is, 7% Kotak is charging, LIBOR plus 1.5% HDFC is charging, and 10 lakhs is the notional principal they are fixed, and they want to exchange the payments. What payment they are going to exchange is, A is who is already paying fixed interest, B is paying floating interest. Now B will be making A's payments. So B will make A's payments. That means the payment from B will go to Kotak, and A is going to make B's payments. That means A is going to make the payment to HDFC. So HDFC is going to accept this at floating only, and Kotak is going to accept this at fixed only. But what has happened here is, instead of A, the payment is made by B to Kotak, and instead of B, the payments are made by A to HDFC. In this way, are they exchanging their payments or not? Please tell me. First, you understand the structure. Are they making the payments to each other or not? Please tell me yes or no. I'm asking a simple question. Are they exchanging the payments or not? Hello. Are you following what I'm saying? Hello. Hello.
Yes, sir.
No, I'm
Yes, sir.
asking question
Oh,
a
yes.
number of times, but no answer.
They are.
Are, so you should say yes, na? Please, because
That's what
like
I
for
said,
me,
sir. They are.
yes, yes. So they are exchanging the payments. Okay. Don't think, you should not overthink now. What is the benefit to both the parties? No, don't go into that. Just understand. Just my question is, are they exchanging? Yes, they are exchanging. Now, coming to the next point about the benefits. See, derivative is a zero sum game. One party's benefit is another party's loss, and another party's benefit is, see, A's profit is B's loss, or B's profit is A's loss. That is understood fact. One party has to lose at any cost. Okay, and the party which is going to lose is the one, like let's say how the payments are going to get exchanged. So 10 lakhs. So previously B was paying how much? Let's say the LIBOR is 8% and it's 1.5. So 9.5 B was paying. Okay. So now that payment will be made by whom? Please tell me. A. Do you agree? Yes. So A will be paying 95,000 to HDFC. Any doubts? Please tell me. 10 lakhs. Let me first calculate 10 lakhs, 9.5%. Okay, 95,000. So A is going to make the payment of 95,000, but A was supposed to make how much payment previously? Forget about 12 lakhs and 15 lakhs. Don't bring that into picture. You only take 10 lakhs, and based upon 10 lakhs, A was supposed to make 70,000 payment to Kotak, correct? But now he is making B's payments now, so he is going to make 95,000 to HDFC, which B was supposed to make. And how much is B making the payment to Kotak? Very simple, 70,000. Please tell me yes or no. Yes. So B's risk. So like now you will be thinking that what is happening here. See, in both the markets, B's market is a volatile market. The rates can go up. Suppose in B's market the rates have gone to, right now they are exchanging the payments. Now, okay, let's say I will not go into all those details. I'm only explaining this, the structure of swap. So what is the like net? This is A making the payment, and A making payment to HDFC and receiving A is making the payment to HDFC. Okay, and he is receiving payments from B, that is going to Kotak, and B is making the payments to Kotak and receiving the payments from A, which is going to HDFC. Okay, so now these assets and liabilities have been created. So for A, the payment what he is receiving from B is an asset. Okay, that means they are exchanging their payments. So assets and liabilities have been created here. B has got a liability of making A's payments, and A has got a liability of making B's payments, and A is getting payment from B and B is getting a payment from A. So what is the difference here? 15,000, correct? Who is going to get the benefit here? B or A? Please tell me. Who is receiving 95,000? I'm asking, who is receiving 95,000? A is making how much payment? 95,000. Correct. Who was supposed to make that? B. So B is receiving 95,000 and B is paying 70,000. Correct. So how much B is receiving additional? 15,000. So it is B's gain or not? Yes. And A's loss? Yes. What they can do is mutually, let's say I'll simplify this concept for you. A and B has mutually agreed. See this, if you do a Google search or any book, you won't get this. For your convenience, I'm giving this last line or last point I'm giving to you for your convenience to understand. What I mean is, whatever the payments happen, they happen. At the end, both the parties agree that whoever gets the benefit, they will share it amongst themselves. So here B is getting a benefit of 15,000 from swap agreement. Both A and B share it 7575. Now you tell me, this swap agreement has created benefits for both the parties or not in this way? Yes, tell me, please. Tell me yes or no. Hello.
Yes.
Are you people like not able to hear my voice?
No, sir, we are able to hear, sir. We also saw you.
Yeah, so mutual benefit is of 7575 to each party, na? So what they can do is they can share that benefit among themselves. So this swap agreement, what has simply happened is, one they both the parties were not satisfied with the payments what they were making, because A was worried that if the rates go down, he is going to make extra payments. Okay, okay. Now that element I have not explained you yet. Okay, so now let's go to that also. Okay, no, but the swap agreement goes in this way only. Have you understood the swap agreement simply? Yes. You have understood that the payments have been exchanged. One party has made a gain, another party has lost. Now let's say this LIBOR. So here the gain is for the B, na? Why? Because the rate is fixed here, and B is making that fixed payment, and in his market the rate prevailing is 9.5. Let's say the rates in B's market have gone down. That means LIBOR has become 5%. Let's say LIBOR has become 5%. So if LIBOR becomes 5%, so 5.5 is what is the interest, correct? Now what is the payment A will make? A will make the payment of 55,000 and B will make the payment of 70,000. Here who is benefiting? A is benefiting. How much? What's the difference? Hello?
Sir, we can't see your screen.
You can't see the screen. Now please see. Once again, please confirm. Can you see my screen now? Hello?
No, yes, sir. Yes, sir.
Yeah. Let's say, I'm giving one more example that in B's market, the floating rate loan, it's a floating rate loan now. So LIBOR, in previous example, I've taken 8. Now let's say the LIBOR has gone down to 5%. How much? Let's say LIBOR has gone to not 5%, 4%. Let's say LIBOR 4%. Okay, I'm just making it here again. A, B, 7%, LIBOR plus 1.5%. In the previous example, we understood that B has made a gain and both the parties have shared. Let's say the rates have gone down in B's market and the LIBOR has gone to 4%, let's say. So now in B's market, the payment made by A would be at the rate of 5.5% because LIBOR is 4%. So A will make a payment of how much to B's bank? 5.5 into 10 lakhs, 55,000. And B will make payment of how much to A's bank? 70,000. So who is in gain now? Who is gaining here? A is making less payment, B is making more payment. So A is receiving extra 25,000, 15,000, correct or wrong? Hello?
Correct only, sir.
Yeah, so that 15,000 can be shared between A and B as per the mutual agreement. So see what is happening here is one time A will gain, then the benefits are shared. Other time B will gain, the benefits are shared. So mutually what is happening is any party who gains in this swap agreement are sharing their benefits. So it is good for them, na? Otherwise they would have paid extra amount to their banks, correct? So swap agreement has reduced their risk of additional payments to bank because one of the both the parties are in agreement and one of the parties is taking additional risk of making the extra payment and other party is gaining, and that party is sharing the benefits amongst both of them. So in this way both the parties are like benefiting from the swap agreement, isn't it so? Now let's say the LIBOR goes to 3%, let's say 2%, so 3.5%. So A will be making a payment of 35,000, B will be making a payment of 70,000. So what is the case here? Who is gaining? A is gaining 35,000. So A will share 17.5 to B, and he will keep 17.5 with him. Can this happen? Yes, this can happen. And let's say in A's market the rates have gone down. See, that is a floating rate, this is fixed rate, I understand. But let's say in A's market the base rate has gone down, let's say to 4%. 4%, okay, base rate. Now B will make a payment of how much? 40,000. And A will make a payment of how much? Let's say it's LIBOR plus 1.5% is like 8% is LIBOR and 1.5. So 9.5%. A is making 95,000 payment. So who is gaining here? B is gaining here. How much? 45,000. So B will share 50% of this with A and 50% B will keep. So in either ways, the payments are exchanged. In one of the markets, the rates may go up or down. But what is happening is one party is losing, one party is gaining. The losing party is also getting half of the gain from the gaining party. That is what the mutual agreement is in swap agreement, which the example which I have given to you. So in this way, are they able to reduce their risk of like the payments what they are making to their respective banks, which A was making fixed and B was making floating? Yes. Any rate change, no problem, because the risk is, the benefits are shared and the risk is also shared amongst both the parties. Correct? Yes. Smriti?
Yes, sir.
When they are sharing the benefits, they are sharing the risk also. That's what.
Yes, sir.
Yeah. So now we will take a practical example from your book and understand what is happening here. Okay. So there is an interest rate swap between two banks. Bank of Eastern US, BEUS in New York, has $100 million in fixed rate loans outstanding with an average maturity of 5 years that earn the bank an average fixed rate of 4%. So what is happening? BEUS is a bank in New York, has $100 million in fixed rate loans. They have given loans to people. So when they have given loans to people, they have to receive money or not? Yes? Yes or no? Yes. So they will be
Yes, sir.
receiving 4% interest from people, and this is fixed. So they will be receiving fixed, and so BEUS, other bank will be BNUS. BEUS, $100 million loan they have given, and they will get 4% fixed receipts from people. That means they are charging fixed interest to people from to whom they have given loan. Now, it also has $125 million in deposits at rates that adjust generally in line with adjustments to 1 year treasury bill rate. So the treasury bill rate will fluctuate. See, what has happened is, see, a bank has dual function. Huh? One function is they will give loans, another function is they'll accept deposits. So the loans, whatever they have given to people, they are charging 4% fixed interest, and whatever the deposits people have made with them, to them they are paying 2.5%, but that is fluctuating. How fluctuating? The 2.5 depends upon the treasury bill rate. If the treasury bill rate is increasing or decreasing, the 2.5% will also fluctuate. Please tell me yes or no. Yes. So right now, 1 year treasury bill rate is 2%, and BEUS is paying an average annual interest rate on its deposits of 2.5%. So what they are doing is they are making 2.5% as floating payments to their customers. What they are doing? Floating payments. Okay. So BEUS deposit rates are increasing every time. Okay, because the treasury rates will increase, and Yeah, okay. This is the deposit rates, LIBOR rates. We'll come to this. Okay. So we'll understand this. It also has, so they have given loans of $100 million and they are having deposits of $125 million. On loans they are supposed to receive interest, on deposits they have to pay interest. And loans they are charging fixed interest, and deposits they have to pay interest at floating rates, and the condition for that is also given. So it has $125 million in deposits at rates that adjust generally in line with adjustments to 1-year treasury bill rate. Right now the 1-year treasury bill rate is 2%, and BEUS is paying an average annual interest rate on its deposits of 2.5%. So they are paying 2.56. Okay, the treasury bill rate is 2%, that is government's rate, but the bank is paying 2.5. The management of BEUS expects interest rates to rise, and the rising interest rates will result in paying higher interest to depositors while continuing to receive only 4% annual interest on fixed rate loans. So now things are very clear here. So BEUS has given $100 million loans to their customers. From them they are supposed to receive interest at the rate of 4%, which are fixed. Okay, which is a fixed payment they will receive, fixed interest. And they have depositors who have deposited in them, and they have to pay 2.5% interest to them. And this 2.5% is not going to be fixed, it will be fluctuating. It's a floating rate, because treasury bonds will, the interest for treasury bonds will change. This will also accordingly change, because this is linked to that. Okay, so fixed receipts and floating payments. Now, and they are worried that the interest rates are going to go up. So what is happening is, what the payments the receipts they are receiving is 4 at the rate of 4%. That is fixed every year. But here, if the interest rates increase in case of interest payments, the interest payments are done to depositors. Interest receipts are received from the borrowers, from the customers. So this from 2.5 it goes up to 3. Let's say from 3 to 3.5, or from 3.5 to 4. What is going to happen? Whatever they are receiving here, that is going to, the net is going to decrease. How? First year first year, suppose let's say on $1,000 the interest payment is 4% here. So 40, 40, 40, 40. But here 25, 30, 35, 40. So what is going to happen? Every time, every year, whatever you are getting the benefit of this is going to decrease. Why? Because the payments are increasing, your cost is increasing, but your revenues or the interest payments are fixed, they are not increasing. That's what is their worry. Now for bank, interest or income, if their interest income is fixed and their cost is increasing, that's worrisome for them. Now another bank's profile. At the same time, Bank of Northern US, BNUS in Cleveland, Ohio, has $125 million in certificate of deposit. So this is their investment, that are fixed rate deposits, and maturity is 5 years, and at an average interest rate of 2%, and $100 million in floating rate loans at an average of LIBOR plus 2. So very simply understood, I'll put the profile of BNUS. BNUS. So here $125 million. $125 million is the liability they have. This is the asset they have. Okay. For BNUS, they have invested in certificate of deposit. That means, what is certificate of deposit? When you invest, when you deposit some money in bank, like FD only, bank will give you a certificate that it shows that you have that much deposit with them, and they'll also pay you interest for that. So they have $125 million in certificate of deposit that are fixed rate deposits. So certificate of deposit. So paying how much? Average interest of 2%. So they are getting 2% interest on their investment. So 2% fixed receipts from certificate of deposit. So you see here they are getting fixed of this much and floating of this much. These are getting fixed of this much and floating is also there. And they have also taken loans, it seems. So they have invested and 100 million in floating rate loans at an average rate of LIBOR plus 2. That means they will be receiving, for certificate of deposit, they are getting an interest of 2%. Okay, has this much that are fixed rate deposits and floating rate loans of 2%. So LIBOR currently is 1.5%. So the current average interest rate BNUS is earning on its loans is 3.5%. Okay, just leave it. Now the things are different here. Actually, BNUS has not invested, but they have issued certificate of deposit to various people actually. Okay, see what happens. This is BNUS Bank. So now understood. BNUS Bank has various customers who deposit their money in BNUS Bank, and BNUS Bank has to issue certificates to those customers who are depositing money with them, like FDs. They're opening FD accounts with BNUS, and BNUS is agreeing to pay 2% to them. That is fixed. Okay, now understood. Fixed payments for certificate of deposit. So BNUS will make 2% fixed pay, will make the payments which would be fixed payments at the rate of 2% to those people who have deposited their money with BNUS, which is an Ohio based bank, and to whom the BNUS bank has issued certificate of deposits. So BNUS has issued certificate of deposits to various customers to the tune of $125 million. Okay, and they are paying 2% fixed interest payments to them. Okay, now, so now one thing is understood, that BEUS is making floating rate payments and BNUS is making fixed rate payments. So BNUS is worried about their payments and BEUS is worried about their payments. How? Floating rate, they are worried that if the interest goes up, they have to make more and more payments. These guys have that fixed payments. They are not worried right now. Okay, so we'll see the story now. And what is happening is this BNUS has given $100 million loans to people, and they are receiving floating payments from people at floating rate LIBOR plus 2. So 100 million floating receipts for loans LIBOR plus. Okay, LIBOR plus 2. Let's see. Now, right now the LIBOR is 1.5%, so the interest would be 3.5%. So they're receiving 3.5% interest. So I'll write it here, 3.5%. So what we understood is, now the things are very clear. BEUS has given loans of 100 million to their customers and receiving interest from customers at the rate of 4%, which is fixed, and they have deposits with them of $125 million to whom they are paying interest at floating rate, and the floating rate is, right now the rate prevailing is 2.5, but it can increase. Okay, because it is at LIBOR. BNUS has issued $125 million worth of certificate of deposits to their depositors, and they are paying 2% fixed payments to them, and they have given loans to customers of 100 million, and they are receiving floating interests from people. Okay, that is LIBOR plus 2%. So things are very clear. So BEUS and BNUS, I'll write it neatly here. So we will just write one thing here. You can make a note. Fixed receipts, floating payments, fixed payments, floating receipts. Fixed receipts, okay, this is one. So things are clear once you can give a reading to this till here. I'll just finish it here, then we'll go forward. Okay, just 2 minutes. BNUS profitability. So if interest rates decrease, so B and US, what they are thinking is their receipts, what they are like going to receive from people to whom they have given loans. If that rate is going to decline, they are going to get like the payments, what they are going to get is less payments. Okay, so their cost is fixed, but their payments, what they are going to get is going to decrease. So that is not good for them. Okay, so I'll just show the problems what they are facing. So here the payments what they are going to receive is at the rate of 4%, and floating payments, that means interest 2.5 LIBOR plus. So if this is going to increase further, it is not good for BEUS. They are worried. Am I right? Because that is going to increase the cost. If the interest payments increase and the interest receipts are fixed, it is not good for BEUS. I explained why, because 40 they are going to receive every time, but their payments are increasing from let's say from 2.5, the rate goes, if the rate is right now 2.5, and on suppose let's say on $1,000 to, let's say 2.5 is 25 rupees. Again it goes to, let's say LIBOR has increased from, let's say like some percentage, let's say it has gone to 3.5 now, so 35, again it's gone to 40. So you are saying here the payments, the receipt is 40 and the payment is 40, so 0. So that is worrying them, correct? Now floating receipts, so LIBOR plus 2. What happens is, if the LIBOR is, let's say 2%, so they are going to receive payments at the rate of 4%. If the LIBOR has gone to 1, at the rate of 3%. If the LIBOR has gone to 0, at the rate of 2%, they are going to receive the payments. Receive the payments in the sense, receipts are going to be floating receipts for them. That is worrisome for them. Why? Because in all the cases, their expenditure is fixed. How? The interest what they are going to pay to the depositors is fixed, na? How much they are going to pay? 2%. So they are going to pay, let's say it's like the payment is 40, 30, 20. So they are going to pay 20, 20, 20. So what is happening if this income is decreasing? Net and net, here they were saving 20, now they are saving 10, now they are saving 0. So that is worrying them. Okay, this is what the concerns of both the banks is. Okay, now. So whatever the concern for them is, we have discussed. Now, let's go further and understand what the next thing is in the question. Each bank can limit its risk of decreased profitability that will occur if the interest rates do what it expects them to do by entering into a 5-year interest rate swap. Okay, excuse me. So now, since they have understood that they have so and so issues and problems, so they will enter into a swap agreement. Okay. So they will for 5 years, and at the same time each bank will give up its opportunity to increase its profitability if interest rates do the opposite of what it expects. However, both banks will have limited their uncertainty about the future. So what is happening is, if they make the swap agreements, both the parties will exchange the payments. How they will exchange the payments? See, what we discussed: BEUS, fixed receipts, floating payments. I'll write it here. BEUS, fixed receipts, floating payments. So worried about the floating payments, what they are making. BNUS, fixed payments, floating receipts. Worried about their receipts because those are floating. So now when they make a swap agreement, the payment what BNUS is making is fixed, the payment what BUS is making is floating. They will exchange. He is worried. Why? Because he is getting fixed income, but if the interests are increasing every year, he is making extra payments, and the receipt what he is getting is fixed. So that is